As the country emerges from the COVID-19 pandemic, advisors and fund companies are navigating a multitude of business decisions to get back to normal and return to in-person meetings. At the same time, advisors are also tasked with refining their portfolio allocations after seeing the equity markets nearly double over the past 14 months. The Dow Jones Industrial Average is up more than 85% since its March 2020 low. I'm Pat Newcomb with Fuse Research, and today we're going to take a few minutes to discuss findings from our Advisor Trend Monitor report, Advisor Top Trends for 2021, focusing on how advisors plan to adjust their asset allocation models over the next 2 years, and which investment categories will benefit or suffer the most. Based on our 2021 Top Trend survey, done in partnership with wealthmanagement.com, nearly 800 advisors were asked how their client asset allocations would change between today and 2023 across 4 investment styles: domestic equity, fixed income, international equity, and alternatives. Advisors unanimously predict a further erosion in their commitment to their domestic equity allocation. Overall, this category is expected to decrease from 52% today to 49% in 2023. Drilling down to specific investment objectives, we found that large cap equities are driving the overall decrease in domestic equity allocations, with nearly 1/4 of advisors indicating they will decrease their allocation to large cap equities. While large cap equities will see reduced allocations, small cap equities will benefit, with close to half of advisors planning to increase allocations to this investment objective. So, where are advisors reallocating those assets in large cap equities? Advisors are strongly signaling a bump in their broad international equity allocation, whether given a belief that large cap equities are generally overvalued, or the converse, that international equities offer greater total return promise, at least over the near term. The current allocation to international equities averages just over 14% today and is forecast to grow to more than 16% over the next 2 years. Taking a closer look at specific investment objectives within international equity strategies, it's not surprising that emerging market, international core, and global represent 3 of the top 4 categories, expecting the largest percentage of advisors to increase their allocation in the next 2 years. Among these 3 categories, emerging markets is expected to see the most significant increase in allocations, with half of advisors indicating they'll increase allocations to the category. For fixed income overall, advisors report that their allocations to bonds will remain relatively constant over the next 2 years. While fixed income allocations overall will be flat, significant variations are expected at the category level. Nearly 1/3 of advisors plan to increase their allocations to emerging market debt, while at the other end of the spectrum, nearly 1/3 of advisors expect to lower their allocations to government bonds by 2023. Finally, on the alternatives front, advisors plan to grow this allocation to 10% in the next 2 years. Advisors with affluent clients, those with more than $1 million in average assets, are expected to see the largest increase. Given the accelerating interest in alternatives, it's not surprising that alternative products of all types and structures are proliferating. More than 1/3 of advisors expect to increase their allocations to commodities and tactical allocation strategies over the next 24 months. Overall, the asset allocation picture at a high level is expected to be relatively stable over the next 2 years. U.S. equity will continue to represent roughly half of advisors' assets, with another 1/4 allocated to fixed income. But when you take a closer look, it's clear that advisors are planning to make meaningful shifts within broad categories in the coming years. While some of these allocation shifts may seem small on a percentage basis, the actual size of assets moving across categories is massive. International equity allocations within advisor portfolios stand to gain close to $1 trillion in assets over the next 24 months, and alternative allocations are expected to grow $500 billion. These shifts will create meaningful opportunities and challenges for fund companies in the very near future. Thank you for taking the time to view this video. If you have any questions about the topic we covered today, or would like to learn more about other topics that are included in our Advisor Top Trends for 2021 ATM report, please let us know. Thanks again and have a great day.